Hello everybody and welcome to our inventory practice exercise. This one is going to cover the perpetual, FIFO, and periodic FIFO methods of inventory costing. What we'll find out throughout this video is that the same results are going to apply for both methods. Now later on we're going to have videos covering the other inventory methods, perpetual LIFO, periodic LIFO, perpetual weighted average, and periodic weighted average. So those methods will have different results, but perpetual and periodic FIFO will be the same. Now, just as a refresher, FIFO stands for first in, first out. In other words, the first costs into inventory, the oldest costs, are going to be the first ones we pull out of inventory to move over to cost of goods sold. LIFO stands for last in, first out, meaning that the last costs or the latest costs into inventory are going to be the first ones to move out. So we're dealing with FIFO first of all. Now this is a pretty straightforward problem, a pretty basic data set, going to be very similar to the types you see. Now the one thing I do want to mention is I'm presenting this problem without a template. We're going to build a template essentially. There are a variety of ways to illustrate this. If you're dealing with textbook problems, sometimes they may give you the template. Your instructor may already show you a template that you have to use. But if you want to create one from scratch, we're going to be talking about that. So the biggest problem is just realizing how to do this type of problem when you're faced with this information. And that's what we're trying to do in this case. So the problem is pretty simple. Phoenix Industries had the following transactions throughout December 20th. They give us all these layers of inventory. That's the term commonly used for each day of inventory, each new cost of inventory. Now notice we have some purchases and beginning inventory. We have the number of units and the cost related to that per unit. But then we also have sales of inventory, the number of units sold, and then we have a unit sales price. It's very important to keep that separate from the cost. And some of the questions down below will need the sales price, but notice the prices are going to be considerably higher than the cost because obviously the company needs to sell at a higher price to remain in business. So just keep that separate. What I'm going to do here first of all, and again, this is the type of problem you'll see. The very first thing you may want to do is create like a total cost column and a total sales column for each layer if they don't already have that. Sometimes they will. So I'm simply going to multiply the units by the unit cost. I'm going to drag that formula down. Obviously, a few of those rows don't have cost, they're sales. And then for those rows, I'm going to take the units multiplied by the sales price. And again, not every row is going to have that either. I'm just going to create a quick grand total here. Oops, I entered two equal signs there. This is just so we know what's going on here. The company had total cost of inventory of $68.50, and they didn't sell all their units, but the sales price of the units they did sell amounted to $56.35. So those are just some check figures we'll use later on. Now, the important part with these problems is understanding what the question is actually asking us. Question 1, how many units were available for sale during the period? How many units were available for sale? So we're not saying how many did we sell or how many are left. How many units were available for sale throughout the period? So notice we basically want to take all these unit counts except for the ones that we sold. Skip over those. So I'm just going to say beginning inventory plus this purchase plus these next few purchases. And we're going to say we sold 560 units. We can't just go and add these up because that includes some sales figures, which are actually minuses if anything. But the units that were available for sale throughout the period were 560. How many units were actually sold? We had 125, 140, and 150. 415 in total. Now how many units remained in ending inventory? That's simply the difference between the units available for sale and the units sold. So we have 145. And finally, or not finally, number 4, what is the value of the total goods available for sale throughout the period? And by the way, this is the cost, the goods available for sale, not the sales price. We already did this up above. The total cost was $68.50. Now, what is the total sales throughout the period? We did that as well. That was $56.35. What I want to stress here is that questions 1 through 5 are going to be the exact same regardless of which method you use. So when we deal with the other problems, we can essentially copy and paste everything we've done up to this point for the other problems. Number 6 and 7 is where we're going to have a difference. That's because for FIFO versus LIFO versus weighted average, we need to know what is the cost of goods sold throughout the period, and it's going to depend on which unit cost we're taking. Notice that the costs have been rising over time, which is pretty common. Of course, this example is 1 month, and this is a pretty drastic cost increase throughout the month, but it's being done to illustrate a point. If we just had the same basic cost, then you wouldn't be able to see anything different. Or even if it was just off by a few cents, you wouldn't be able to see any major difference. So in this case, it's just easier to use drastic cost increases to prove that point. So what we would do now, the cost of goods sold throughout the period. There are a variety of ways to illustrate this, as I said. And again, you may have a template that you have to use already. But the way, if I was starting from scratch, the way I would do this is I'm going to take my data set, my layers of inventory. I'm going to copy them down here a little bit. And again, this is basically for number 6 and number 7. That's all this is the data that we're starting with. Now, by the way, we don't need the sales here. We just need to know the layers of inventory we have available for us. Because what we're going to see is that this is basically the inventory that we're using up. So we're going to take this, and really this is more for number 7. I'm going to call this, in the end, we're going to get the ending inventory. It's not going to be ending inventory right away, but we're eventually going to be moving that over to cost of goods sold. So, and I'll get a total here as well for both the unit count as well as the value. Just going to, oh, no, can't do that. Sorry. We need to get a total here. I didn't carry that formula down from up above. And I guess the proper term is product because we're multiplying. And then I can add those up. And we have $6,850 in inventory. That's what we came up with up above. So we're right where we need to be. That's what we start with, or that's what we have available. Now what we're going to be doing is eventually moving this inventory out to cost of goods sold. So what we're going to do here is take a look at each sale. And December 7th, we sold inventory. So we want to know, where do we get the December 7th sale? We know we need 125 units. The question is, which units do we pull? The costs are all different, so it does matter which units we pull. We can't just randomly grab a price. We have to figure out what order we're supposed to go in. We only have so many units at each cost amount. So once those units are gone, we have to move to the different cost amount. We're using FIFO, first in, first out. That means the first units in, or the oldest units, are going to be the ones we use first. So FIFO. We need to sell 125 units. Fortunately, the very first layer that we need to use first has 150 units. I'm just going to say from December 1st, beginning inventory. We only need 125 of these units. We have 150. They're $11 per unit. Since we've taken 125 away, we need to keep this up to date. So now we only have 25 left. 125 out of the 150, we only have 25 left. Notice how that updated this total amount here as well. Now what I'm going to do also is for every single row, in fact, let me do this just to get the formats looking nice. And this as well. So for every single row, I'm going to have a total here. Again, it's a product. We're multiplying the two together, so it's the product of these two items, 125 units times $11. The amount there was $13.75. I'm just going to call it total. For the December 7th sale, this is the amount because there was only one line. So it is $13.75 for this December 7th sale. No tricks to that one. We've kept everything updated, so we're good to go. That one's gone. That one's taken care of. Now the December 20th sale, we sold 140 units. So we need 140 units. We have 25 out of this first layer that we can use up. So it's the same thing, December 1st, beginning inventory. We're going to pull the 25 away. So now we have 0 left. It's $11. 25, but we needed 140. So we need 115 left. We go to the next layer because FIFO moves down. We move forward in time. So we can basically take the December 3rd inventory and we can only have 110 of them. We need 115, but there's only 110 here to deal with. So we're going to take that away. I'm going to do my multiplication here again. We need 5 more units. It's going to have to come from the December 12th inventory. And we only need 5 of them. So now that's down to 80. $12.25 was the price. Multiply these. And now we know we have everything we need for the December 20th sale. It's going to be these three added together. It's going to be $1,629, or you can do the sum of that if you'd like to. $1,629 was the cost of these units. Now we're going to do the final sale, December 30th. So I'm just going to bring this down here and change one character. So in this case, we need to look at what we have left. Well, first of all, what do we need to sell? We need to sell 150 units. The first layer we have is December 12th. We have 80 units. So we're going to pull that. And then we're going to update that. It was $12.25 we just used. We did the math there. It looks like everything was already multiplying. So that was 80 of them, but we needed 150, so we need 70 more units. Fortunately, the next layer that's available has enough for us, and that's coming from December 15th inventory. And we need, what did I say, 70? Which means we only have 50 left up here. The cost was $13. It's multiplying for us. That takes care of our 150 units. Again, we can sum up the total cost for all of those. That's our December 30th sale. Now I'm going to do a grand total here. We have $48.94. So the total cost of goods sold throughout the period was $48.94. The ending inventory, which we've been updating, is $19.56. Again, those are dollar amounts. Now, as I said earlier, this $68.50, the value of the goods available throughout the period, it has to be in one place or the other. Either we've used it up, in which case it's cost of goods sold, or it's left in ending inventory. So these two things added together have to equal that goods available throughout the period. We had $68.50. We figured that $48.94 of it was cost of goods sold. The other $19.56 was ending inventory. Just as a double check, if we add these two together, sure enough, we get $68.50. If you don't, and it's not a rounding issue, if you have a, depending on what value they give you, you may end up with a very small, like $1 or $2 rounding variance, and that's fine if they've rounded the cost. But in this case, everything was pretty straightforward, pretty cut and dry, so it matched up perfectly. So that's just a great check figure. Even if they don't ask for that problem or that question in your problem, it's not a bad idea to calculate it up front so you know what to expect at the end. So this is one way to do this type of problem. There are many other ways to illustrate it, whatever works best for you. But the reason I did it the way I did is to show you that the inventory starts as an asset, and we eventually move some of it to cost of goods sold expense. Once we move it, that it starts adding up into cost of goods sold, but it subtracts out of our ending inventory. The way we built this, it constantly updated, so in the end we have our final results. Really, number 6 said cost of goods sold throughout the period, number 7 said ending inventory. As we moved everything to cost of goods sold, we were left with that ending inventory. So number 7 was done for us as soon as we did number 6. So that's the way I like to build this particular type of problem. Again, whether it's FIFO, whether it's perpetual or periodic FIFO, it's going to be the same result. Now, what I want to stress there, the difference between perpetual and periodic are simply how often do we do these calculations. Perpetual says we do it every single time. So on December 7th, we would have had to take a look at what we had available at that time, which are just these first 2 layers. We would not have even known about these other layers yet. So the only thing we could have possibly pulled from would be these 2 layers. And then by the time we get to the December 20th sale, now all of a sudden we have access to 4 different layers of data. The thing is, with FIFO, those later layers that are just now added don't really matter anyways, because we're always using the oldest ones and moving forward. That's why FIFO perpetual and FIFO periodic end up with the same result. So that's one thing to keep in mind. When we get to the other methods, though, you'll see LIFO does have a difference, because whether you do the entry every single time you have a sale, or whether you do it based on the entire period's data at the end of the month, it will make a difference, because your last layer is going to be different at those different times. So that'll make a little more sense when we get into those methods. But with perpetual FIFO, whether we have access to all this data up front or just the couple layers that are available by the time of that first sale, doesn't matter, because we're always going to be starting with this oldest layer anyways. That's the point I want to make. With perpetual, you don't do any of these costing inventory entries or calculations until the very end of the period, at which time you have access to everything. Again, that's the difference. So hopefully this has helped to clarify what we're doing, how you calculate inventory for perpetual FIFO and periodic FIFO. we're going to see additional videos covering each of the other methods. Periodic LIFO by itself, perpetual LIFO, and then we get a little bit more tricky with weighted average, a little more calculation involved, and it's going to be different for perpetual versus periodic. Periodic weighted average, by the way, is extremely easy. It's the easiest of all the methods, but we'll see the difference between all of them. So hopefully this has helped. I thank you for your time, and I'll talk to you in the later videos.